Before I kick off, I just want to draw your attention to the regular disclaimers that all these kind of events go. So, as Renee said, my name is Lee Harris. I'm from a software company called Emoji Trading, and in today's session, we're going to explore how and why to introduce order flow to your trading. And what I'm going to aim to do is really take things back to very simple terms to help you evaluate whether you should be considering applying order flow to your trading. Order flow is one of those concepts which has become really popular over the past few years. There's quite a bit of hype, there's quite a bit of perceived magic about it, but actually it is a really simple concept. And during today's session, I'm going to explore some of the terminology, demonstrate 2 or 3 of the important concepts around interpreting the volume of the market, and show you how you can use that to really simplify your trading. I'd certainly like to make this as interactive as I can. Please pop questions into the question box in the chat box, and if our time allows, or if I'm able to do so in the flow of the presentation, I'll certainly do my best to answer those. Now, at Emoji Trading, what we focus on is we try to make it as easy as possible to see the supply and demand that's within the market by looking at the order flow in the market. Why is this important? Well, as day traders, we want to be on the right side of the market. So we want to be aligned to the more powerful supply or demand. There's no point us with our 1 lot, 2 lots, 5 lots trying to fight the bigger participants in the market. So if we are able to determine where there is supply and where there is demand, so we've got some levels to trade on, and for all of the buying and selling battles, we can understand who's winning. If we stay on the right side of the market, we've got a chance of making some money. But as well as that, by identifying where there is supply and demand, it allows us to trade using incredibly tight stops. And I'm talking 2 ticks, 3 ticks. The key to survival when you're trading is retaining your equity. So if you have high quality entries that are very precise, well timed, have specific levels, by definition, you can minimize your risk by having well-defined tight stops as well. And by visualizing this using tools like our software, and I'll go into that a little bit more later, then you're able to trade in this very calm, very precise, low risk, high reward manner. So what do we mean by order flow? Well, to answer that, let's take a look first of all at how many retail traders are actually viewing the market. And this chart, maybe it doesn't reflect exactly how you trade today, but I'm sure that you have built charts using combinations of indicators much like this. So what we have here is a regular candlestick chart. We've got some bands, probably Bollinger Bands, floating around the price action. So we're seeing what's relatively high, what's relatively low. We've got a MACD sitting below it, a MACD histogram. So this is telling us about the convergence and the divergence of multiple moving averages. So how far apart does historic view of price come and go? Below that, we've got an oscillator, an RSI. So this is giving us a sense of momentum. But the key thing to understand on this chart is everything that we're looking at is derived from price. So what we're seeing through the movement of the candlesticks is just reflected in different ways, different formulas by every other indicator, every other indicator on this chart. So we're seeing price in 4 or 5 different flavors. What we're not taking into account whatsoever is volume. Maybe today you put volume on your chart, probably as a little histogram at the bottom of the chart, a little bar chart. So you can see, oh, that bar was high volume. That bar was relatively low volume. But without looking at volume, if you only rely on price-based indicators, you really are making your decisions way after the underlying supply and demand event that has caused price to move has occurred. Price moves because of changes in volume. And we'll get into that in a bit more detail shortly. But if we take price, and then if we take the derivative of price, whether it's a MACD or a Bollinger Band or an RSI, and we make our decisions on that, we're 2 steps removed now from actually what occurred. It's only by looking at volume that we can really understand the forces which are going on in the market, which are causing price to move. So if we're going to put a definition on order flow, we can think of order flow as looking at the impact of volume on price. And there are really two areas of volume that we can consider. First of all, we can think about the volume that is advertised into the market. So here we've got a typical trading dome. Okay, it's not a real dome. I've made this up in my presentation software, but you get the idea. We've got our ladder of prices down the middle. On the left-hand side, we can see the volume that is available. And on the right-hand side, we see the volume that's available to buy. So at the current price quote, 24.53 versus 53.25, what we can understand is that there are 480 contracts available for sale at 53.25. So whether it's one seller or 480 sellers, at this moment in time, if we want to buy, we can buy up to 480 contracts at 53.25. Equally, at 53, there are buyers advertising their intention to buy up to 1,134 contracts at 53. And that's how the price quote is formed. So we're seeing the intention of the market. This is the advertising of the quantity that market participants are prepared to buy and sell. So what happens when things trade? Price only moves because volume trades. So let's imagine that somebody decides to buy 500 contracts at market. In order to do that, they consume the 480 contracts that were being offered to sell at 53.25. The remaining 20 contracts are bought at the next price level, 53.5, taking the available quantity to purchase down from 347 to 327. So this buyer who wanted to aggressively enter the market and buy 500 contracts at market has actually moved the price quote. We now go 53, 53.5. Of course, in real life, bids and offers come and go. It's rare on most instruments for the quote to spread wider than one tick. But hopefully this helps you see and understand that price does not just move. It is volume which causes price to move based upon the availability of contracts to be bought and sold. If you are not looking at volume, you are not getting anything like the full picture as to why price is moving. So that's the advertised volume in the market and the how and the why that price moves. But we can also think about the volume that has traded within the market. And order flow, if we look at the impact of volume on price, considers this. It's very important. This is a chart type known as a footprint chart. This was introduced to the world by a company called Market Delta. You may well have heard of them, and they actually trademarked the phrase footprint chart. This kind of chart style is available in various other platforms. What we're looking at here is Sierra Chart. It's the platform I use for my trading. It's the platform in which we publish our indicators. But other retail platforms, NinjaTrader, IRT, you name it, pretty much every charting platform out there has got some ability to show the historic traded volume. And what you're seeing here in the candlestick bars is a historic record of the volume that traded at the bid and at the ask. So if we look at the first blue bar on the left-hand side at 8:32 in the morning, at the very bottom price level, we see the numbers 711 by 363. This tells us that 363 contracts were bought at market. 363 contracts lifted the offer. Likewise, at the same price level, 711 contracts hit the bid. 711 people sold at market into buyers that were happy to pay that price. So this gives us kind of the historic view of what happened through the dome, which we saw earlier. So we not only consider the intention, the advertisement of supply and demand that's out there, but we can track the history of what volume traded and how at every price. So in summary, price moves because of buying and selling. But we can look for patterns within the traded volume, in other words, the history of buying and selling activity, and this provides us with indications of price levels where there is supply and demand. Armed with this information, we can start to make better trading decisions. If you think back to when the trading pits were live in Chicago, a trader would walk into the trading pit with a pen and paper, and armed with really nothing else, maybe a record of the previous day's levels and some basic calculations, their trading decisions were based upon watching how the market, the other 100 traders around him, were trading. They would remember who was buying what quantity and where. We now see it digitally on the screens through numbers, but the same principles apply. If we know who is prepared to buy and sell at a particular price level, if we know how much has been bought and sold at a particular price level, then we're in a really strong position to make informed, low-risk trading decisions. It all comes back to the basic economics of supply and demand. I'm sure if you've done any economics 101 class, you'll be familiar with this type of chart. So on the left, we have a demand curve. Basically, at higher prices, we have fewer buyers. As price falls, more people are prepared to buy, all things being equal. The inverse applies with supply. At high prices in the market, lots of people are happy to sell. At low prices, less people are willing to sell. And if you keep this very simple view in mind, it can really refresh your outlook on trading without thinking about bands and averages and crossovers. And one of the key ways to do this is keep relating it back to being a market and what happens in the real world. Let's give some examples of that. Today in the UK, there is actually a prestigious auction of historic and valuable and classic Ferraris. It's happening somewhere in the UK today. I'm not there. I can't afford to buy one of these yet. But you can see in their advert, they're offering for sale this 1972 Ferrari with an estimate of between £500,000 and £575,000. Clearly, this car is one of a kind. It is rare. There is low supply. It is only one car. There are more buyers, one would assume, than this physical car. If there are 2, 3, 4, we implicitly have more demand. That's why its price is high. It's scarce. We have low supply. Let's think about the opposite scenario. If I want to go out tomorrow and buy a run-of-the-mill car, a Ford Focus, not only are there hundreds available on the market at any point in time, I can go to hundreds of Ford dealers. That product is a commodity. So the sellers, the Ford dealers, will be competing on price in order to get my business. Sure, the retail price represents a balance between the supply and demand, how many consumers at any point in time want to buy that car, but it's a very different proposition when there is plentiful supply versus limited demand at this point in time compared to the rare Ferrari, which is up there. So if you start to liken your trading to the decisions that you make when you buy or sell something, maybe it's a house, maybe it's being at the supermarket and seeing that, you know what, this cereal is on special offer. Maybe I'll buy 2 boxes, not 1. That's exactly the same principles of supply and demand and high prices, lots of sellers, not many buyers that we can see on the screen when we're trading. So just use common sense, day-to-day stuff to simplify your trading. Now, in terms of the patterns that we can see when we start to look at traded volume, there are various terms that get thrown around, and I'm going to try to explain some of these and illustrate how you can use, how you can make good trading decisions based upon identifying these events which occur. And 3 of the real standout situations that occur in supply and demand are exhaustion, absorption, and imbalances. So we'll take a few minutes now to go through each of these. We'll line these to various examples, and hopefully this will start to make sense and make you think about how you can bring order flow into your trading. Let's start with exhaustion. Well, you know what? Part of this, the clue is maybe in the name. Exhaustion occurs when we start to run out of buyers or we start to run out of sellers. So as prices go up and we get fewer and fewer people willing to buy, we experience exhaustion. We're running out of buyers. This can be a sign that an upward move is running out of steam. Momentum is falling, less people are buying. We're coming to the end of a trend. So what's your trading decision in this case? Well, you're unlikely to want to enter a market long if you see that fewer and fewer buyers are buying. You may be, if you're already long, want to close all or part of your position. Let's take this back to the real world. At the auction today for this £500,000 Ferrari, we're going to get to a point, maybe at 400k or 500k, where the 4 or 5 buyers get whittled down to 4 or 3 or 2. They're looking at their bank balance thinking, you know what, this is maybe a bit too rich for me. That's exactly what happens in the market with exhaustion. So let's look at some examples. Here is a footprint chart. The only things which I'm showing on this chart are the footprints, the volume that traded at the ask and at the bid. You can see that there's the numbers in the candlesticks. The red line is the daily high, the blue line is the daily low. And this chart is of the CL future from Wednesday just gone, which would have been inventories day. Now we see the market opens at 9 o'clock, first bar, opening the market, you know what, who cares? We're not going to get meaningful information. But as we start to progress through, we can see that at 9:25, one tick away from the high of the day, which was the opening bar, we actually see some exhaustion. That's indicated by the pink box at the top of that 9:25 bar. We ran out of buyers, falling short one tick away from the high of the day. Now, one tick away, you tell me, is that coincidental? Or are people actually looking at price and making their decisions accordingly, and no one wants to buy that close? We carry on churning away. Note again at 9:40, again, one tick off the high of the day. We don't go any higher. No one wants to buy there. What gets interesting, at 10:05, we break the low of the day. We break what would be known as the initial balance low. So we break it, but the selling slows down. We see that from the blue box. In the next bar, we continue to go lower. Again, we've got exhaustion. At these lower prices, we're starting to run out of sellers. We churn around a little bit, and then boom, leading into the inventories, we get a strong move up at 10:30, no surprise. 10:35, the move up continues. The pink box shows us, though, that we're running out of buyers at this high price. Then at 10:40, we go a couple of ticks higher again, even fewer buyers. That seems to be the end of the run. So going back to our simple supply and demand curves, at lower prices, we start to run out of sellers. At higher prices, we start to run out of buyers. So combining that with a little bit of context, we know the high and low of the day. We know that we've got news, so it's based around the inventories, and we can start to actually see the supply and demand, the nature of the market that's going on. What we can also see, is along the bottom of the chart. And let me just see if I can highlight this. Here we go, the pointer. Along the bottom of the chart, we're exposing something called delta. Delta, very simply, is the difference in the number of buyers and the number of sellers. So for each bar in this chart, we're counting up how many contracts were purchased by lifting the offer, how many aggressive contracts were bought, minus how many contracts were sold by hitting the bid. The difference between that number is called delta. So if we have more contracts bought than sold, our delta is positive, it's blue. If we have more contracts sold than bought, then our delta is negative, it's pink. We can also start to see exhaustion by looking horizontally at the delta. So as we look here, when we, at 10:05, broke the low of the day, we actually had quite strong negative delta. We had more selling than buying. But when we went a little bit lower again, the next bar at 10:10, although we still had negative delta, it was much less negative than in the previous bar. So yes, we had selling power, but we had less selling power than before. And one of the really neat tricks, which I like to do when I'm evaluating order flow, and I use this to help my own trading decisions, is actually speak what I'm seeing in plain English. And you'll find that combined with a really clear, simple order flow chart, narrating the events in plain English really can clarify your trading decisions. So in the period between 10 o'clock and 10:10, we could describe this that at 10:05, price made a new low, but we started to see sellers become exhausted. The rate of selling slowed down. At 10:10, we went even lower. Price made another new low, but the selling power, the delta, significantly reduced. Now, if I say that to you, that we made a new low, sellers are getting exhausted, and the power of the selling has significantly reduced, I think you'll agree that makes it quite clear what sort of decision to make. You're certainly not going to want to go short. If I asked you, do you have a bias based upon a new low price, but a significant reduction in the power of selling? If I said, would you go short or would you prefer to go long? I would suggest you're going to say you want to go long. Now, if that was your decision to go long, somewhere near the low, 3, 4 ticks off the low of the day, your risk there is 4 ticks, 5 ticks. Your natural stop is going to be at or maybe a few ticks behind the low of the day, and look at the upside that you could have. We can see the same thing as well at 10:35 and 10:40, where we made a new high, but we started to see that buyers became exhausted. At 10:40, we made another new high, buyers were exhausted again, but delta turned from positive to negative. Let's talk this through in English. Price made a new high, buyers became exhausted, and we no longer had buying power, we had selling power. I would suggest that makes it really clear as to what your trading decision is at that point in time. And literally, that's how simple interpreting order flow can be. This chart only has 2 indicators on it. We have an indicator which is showing exhaustion, the pink and the blue boxes in the main price chart, and we have an indicator showing delta, the histogram at the bottom of the chart. We've got a little bit of context, the daily high, daily low, and that's it. And this chart very easily is giving us 2 very nice trades in CL from last Wednesday. If you still feel this is too much information though, it's possible to look at order flow on a simple candlestick chart. Here is exactly the same chart represented through candlesticks. We have the same indicators, the pink and the blue boxes showing exhaustion on the candles, and the delta below the main chart. I've circled the same areas which we were talking about, and I've also put arrows indicating the change in delta. So if potentially you find that the footprint chart is overwhelming, there's just too much information in it, it is totally feasible to trade order flow off a regular candlestick chart, as you can see here. The next concept I'm going to go through is absorption. This takes a little bit of a mental leap. Absorption is how you visualize what is not happening. And I'm going to try and bring this to life using the example of what happens when, there's a hurricane, something like that. We see it, unfortunately on the news every now and then, that there's a storm warning somewhere in the Caribbean. People rush to the supermarket, they buy bottled water and all the other necessities in order to lock up their house. That is not a normal situation for a supermarket. It's very rare that you're going to find a supermarket runs out of anything. To see an empty shelf in a supermarket, really is strange for us in the Western world. What's happening on the left is that buyers have absorbed all the selling in the market. If we turn that, though, into the situation on the right, let's imagine I wanted to speculate on the possibility of a hurricane occurring. I could go to Walmart and I could think, I'm going to stockpile water. And I could try to buy all the water that's on that shelf. What will likely happen is the supermarket's going to replenish the inventory on the shelf. The supermarket has far more supply than I'm able to consume on my own. So I will buy, they'll keep filling up the shelf. They are absorbing my buying activity. They'll probably continue to replenish until I run out of money. At the point I run out of money and I can't buy any more because they've absorbed all my buying, what am I going to do? I'm going to try and sell all this water, which is now clustering up my house. But how can I do it? I've got to compete with the supermarket. The only way I can sell it is actually by selling it at a lower price. I have to undercut the supermarket if I want to clear my inventory. What will happen? Buyers will buy from me at the lower price. The market moves down in price. Maybe the supermarket says, you know what, Lee, screw you. We're going to cut the price by 10 cents a bottle. The market moves down. So absorption is when a large counterparty in the market has more power than those people who are actively trading with them. So the art of spotting absorption is visualizing what is not happening. In other words, buying is occurring, but price is not going up. We can visualize this with various indicators as well. So you'll see at 8:34 at the bottom of this chart, we've got a blue box indicating absorption. At the low of the day, a large passive buyer was absorbing the selling. At 10:21, one tick off the high of the day, a large passive seller absorbs all of the buying. And note, when we have absorption, price retreats. So the passive participants in the market have sufficient power to stop a move. It's very hard to see on a candlestick or even on a footprint chart like this, but when you're able to highlight it with absorption indicators, you can avoid being wrong-footed because you're able to see the actions of the counterparty that otherwise can be hard to see. We can take this one step further with some visualizations. In our software, we call this an emoji zone. And what this is actually doing on the same absorption indicators is projecting this price level out kind of as a bookmark. So we can track that the level exists and actually look at its importance in the future. We can also track how, if it's tested in the future, whether it holds or whether it breaks or whether it's likely to break. So if we look at the period around 909, 919, we can see that there is absorption of selling at 27.04 3/4. So there is a passive buyer at that price who's happy to buy. They bought in the 906 bar, they bought in the 909 bar, and it's the fact we have the absorption at that price level consistently which allows us to identify that as demand. We then project that price level out. We can see it holds in the 919 bar. We can see again at 946, it holds to the tick. This latent demand that is there from a passive buyer has been maintained. You will absolutely not see this kind of thing on a candlestick chart. It's only by interpreting traded volume, possibly by reading and interpreting the numbers in the footprint or making your life easy and using software like ours, which allows you to visualize it and bring it to life, that you have any chance of seeing these underlying supply and demand events in the market. And that's how you can avoid being wrong-footed. So that is absorption. The final type of supply and demand event, which I want to cover off today, is imbalances. And really, imbalances is pretty much how they're described. It's when we have a strong imbalance between supply and demand. Now, today's auction of Ferraris, the estimate on this car is between £500,000 and £575,000. But what happens if maybe today it sells for £750,000? You know, some buyer with an absolute heap of money absolutely wants to buy this car. So a few things can happen here. Maybe lots more of these Ferraris come onto the market because sellers are motivated by the high price. Maybe other speculators think, you know what, these Ferraris are getting more valuable. Somebody has just paid £750,000, 50% more than the estimated value. I think it's time that I need to start buying as well, and I'll add them to my collection because prices seem to be going up. So the presence of a powerful buyer, or a powerful seller indeed, is enough to incite other people to follow them. What becomes interesting for us, though, is being aware of the price levels at which these powerful traders present themselves, and then looking at the market's reaction when we revisit those price levels. Here's how we see it on a chart. So here is ES from a couple of days ago. we can see at 11:05 from the blue box, we can see that we have a lot of buying activity suddenly enter the market. And the context of this is the market has moved up towards the high of the day. At 11 o'clock, it breaks it by one tick. And then a lot of people pile in on this breakout. So we can see over 1, 2, 3, 4, 5, 6 different price levels, a lot of volume enters the market and buys, and this continues. You may have been able to catch that in real time, but you know what? If you're doing that in real time as it's occurring, you're pretty much late for the party anyway. What's more interesting for us is when price comes back to this area where demand entered the market, did the people that entered the market defend their position, or did they sell, or was the opposite side of the market strong enough to actually force the market the other way? What we can see here is that at 11:20, the market came back to the area where lots of demand entered, and this held. We see this by the transition from the solid blue to the outline blue. That tells us the demand remained present in the market, and look, in fact, the market continued to go up. So by identifying the events and identifying the quality of what happened upon the retest, we're able to make well-informed, low-risk trading decisions. You could have potentially entered the market with a limit order somewhere between 21 and 22. Your stop would have been around 20, so 1 point of risk. Your upside, well, it very quickly went up to 27. So you're looking at a 5-to-1, 6-to-1 risk-reward ratio, purely based on the ability to identify a set of prices where there was strong demand. Here's another example. This shows actually what happens when the demand disappears. So we can see at 2:18, again, we have a similar amount of buying. We call it a stacked imbalance enter the market. Yes, price continued to go up. We have some other indicators though showing us that demand was weakening. We're experiencing exhaustion. Not surprising, we've had a long run up. As we fell back though at 7:30, the demand held for a while, but then 7:34, bam, we have this big red bar that cleanly breaks through this historic demand. Whoever created this demand is out of the market way before that. Maybe the people who were late to the party have got trapped. They're like me buying all the water from the supermarket trying to speculate. They've either run out of money, their position's gone against them, they bail, and that accelerates the selling, which is occurring in 7:34. And in fact, we see another band of aggressive selling occur, which when we look at 7:45 to the tick, acts as supply once again. So as well as being able to identify when powerful supply and demand enters the market, we can also evaluate how these traders defend or bail or reverse their position at that time, which allows us to make well-informed decisions. So those are some of the basics of order flow. I've shown you how we can visualize it within charts. I've shown you how and why price moves, and I've shown you some visualizations that help us to bring to life the concepts of exhaustion when we run out of supply demand, absorption when a powerful player on the opposite side of the market is more powerful than those they're trading with, and also imbalances, the aggressive actions of powerful traders. But if you want to take advantage of these concepts, then really, what are your next steps? Well, first of all, I would encourage you to wonder, can you clearly see now what is happening in the market if you are trading using a chart like this? All we're seeing here is price and the derivative actions which come about through various mathematical calculations. For me, this is hard to read. I can see relative highs and lows, I can see a squiggly line, but I'm so far removed from the forces that are actually driving the market, it's very hard to make trading decisions. And you know what, even if I do from a chart like this, my stops are going to be so wide that I might as well be guessing. If you start to introduce order flow to your trading, and here's the exhaustion chart from a little bit earlier, you'll see that you can trade with much cleaner charts. You can almost stand back from them and read the story that the market is telling you. I mean, it's as if the computer is screaming at you what is happening. If you're not sure, speak through in natural language what's happening. Price made a new low. Sellers became exhausted, and the amount of selling power became weaker. With explanations like this, it becomes really easy to make good low-risk trading decisions. So the first step is reevaluate price-based indicators versus introducing order flow to your trading. If you're still unsure about that, then here's another thought. Don't prejudge the arbitrary levels that everyone else in the market can see. Let the market tell you what to do with them. So we have price-based indicators like MACD, like RSI, like moving averages, like Bollinger Bands, but we've also got simple levels, Fibonacci's, pivot points. What becomes very interesting when you explore order flow is when you put these commonly used levels on charts. Here's a chart with the daily pivot points. Pivot points were popularized by pit traders because it was an easy way with your pad and paper to work out some bounds and some likely levels for the day. What you will see is when you look at these levels that everybody can calculate and see, Fibonacci's, pivot points, VWAP, if you overlay order flow on this kind of chart, you will see that the participants in the market are making their decisions based upon these arbitrary levels. But we don't care about the arbitrary levels, so why should we prejudge based upon a horizontal line? What's more interesting to us is that we experience exhaustion or absorption at an arbitrary level. Now, it's this event of the exhaustion or the absorption which is the event upon which we want to make our trading decisions. Now, if our goal as a successful trader is to be on the right side of the market, we don't need an arbitrary horizontal line on the chart. All we need is visibility of the market's reaction to traded volume. So I would suggest remove these arbitrary horizontal lines and trade off the cleanest chart possible that purely shows you absorption, exhaustion, supply and demand, and the market's reaction. And then really the final step to introducing order flow to your trading is get equipped. Explore and learn some of the concepts behind order flow. I've taken a really quick walk through some concepts of absorption, exhaustion, and imbalances today and explained how volume is why price moves. We've got a series of videos which we've put up on YouTube at youtube.com/emoji trading that go into a bit more detail. You can also visit our website. We have various blog posts. We've got explanations of our indicators. And we aim to explain this stuff as simply as possible in simple, plain English terms to demystify and add simplicity to your trading. So please visit our YouTube channel, subscribe there. We put new videos up periodically, and you can start to embrace some of these concepts. The next step is to invest in a charting platform that is able to produce these footprint charts. Most resale trader-focused platforms will do them. Market Delta introduced them. Sierra Chart, our favorite platform, has them. They won't always be called a footprint chart, but you should always be able to visualize the traded volume at the bid and the ask within your charting platform. But that on its own is just going to give you a chart full of a footprint, lots of numbers. I would contend your final step is make life easy in your trading by using visualizations such as ours that allow you to clearly see the underlying supply and demand events which are going on in the market, bring them to life, and in fact on our technology with our proprietary emoji zones, actually track the history of this supply and demand as it's retested so that you can assess its quality and trade with very tight stops, low risk entries, and high risk to reward ratios. We can help you get started with this. If you visit www.emojitrading.com/trial, we can get you set up with a 30-day trial at no cost of Sierra Chart through our friends at Infinity Futures, a Chicago-based brokerage. They will give you a 30-day trial of Sierra Chart at no cost, including real-time CME data. On top of that, we will give you access to our premium Emoji Trading Order Flow Suite, which has 30 supply and demand indicators combined with our Emoji Zone visualizations. Our visualization package is available on various subscription and lifetime license options. It starts from only $99 a month, but you can take a no obligation, no risk trial for 30 days by signing up at www.emojitrading.com/trial. Now I can see that time on this session is pretty much running out. So I hope you've enjoyed this how and why to introduce order flow to your trading. I hope it's thought-provoking for you. And please do visit our website, get in touch if you've got any queries about it, and we'd love to help you on the journey to incorporating order flow into your trading. Thank you very much.